Good morning and welcome to the Blevins Franks webinar on navigating UK inheritance tax changes. My name is Ben Simmonds. I'm the Regional Director for Blevins Franks here in the UK, and this morning I have the pleasure of being your host. As always, we are utilising technology and it is live webinar/TV, so you never know, we may end up with some technical difficulties or somebody's children appearing in the background, but we must embrace and enjoy the modern technology that we live in. Thank you to all of you that have submitted questions in advance. It has helped us plan this morning's session. I know there were a number of questions still coming in this morning, so apologies if we don't get every single one answered, and there will obviously be the chance to follow up with us afterwards. And if you're an existing client of Blevins Franks, well, you've got the chance to talk to your private client manager and your advisor after this. With regards to navigating inheritance tax and actually estate planning in general, for most of us, it actually starts with a blank piece of paper. And as you're thinking about today's session, what I would actually encourage you all to think about is what you're looking to achieve and what you want to get out of it. Because estate planning and navigating inheritance tax changes is different for different people. For some, this is all going to be about actually what happens to the money on death in terms of what they could have done prior to that. Should they be thinking about whether they gift money to their children and help them with a property purchase? For some, it will be about thinking about grandkids' school fees. For some, it will be the consideration of care home fees in later life. Others will be hell-bent on making sure they pay as little tax to HMRC or any other government throughout Europe. What we do know, though, is that if you get it wrong, what you can end up with is further stress at what is often a very emotional time. There may end up with disputes, delays, or you could end up paying taxes that would certainly have been avoidable. It is often said that planning was best done many years ago, but the second best time is now. So with that in mind, as we think about the planning, for a lot of people, it's been fairly serene and they've had their plans in order. But for a number of you, one of the key things that has been concerning you and has obviously triggered why we're doing this event this morning is what's happening in April 2027. We know that pensions will be coming in to your UK estate. For that has caused a lot of concern for a number of you. And thank you again for getting in touch with us to raise this, because it enables us to talk through today what options you actually have available to you and how you can help you and your family with your financial peace of mind for the future. So before we delve into inheritance tax and the current landscape, let us meet our two experts this morning. Firstly, I'll introduce Mr. Niall Allardice, who's one of our financial advisors based here in the UK. Neil, could you just introduce yourself, please? Tell us a little bit about you and also a little bit about Blevins Franks, please.
Sure. Good morning, everybody. If you're in the UK, I believe we've got some people from Europe as well, so good afternoon to you. Niall Allardice. I usually spend most of my time when I meet people saying I am a Neil and not a Niall, due to being a Scotsman and not Irish. Been in the industry for 34 years now, mainly around tax planning for UK people. So Blevins Franks is something different for me with a cross-border aspect. For those of you that don't know about Blevins Franks, it's a firm with over 50 years history. Started with people immigrating into parts of Europe, but has grown a substantial UK business now as well, because we had so many inquiries from people looking to leave the UK. The majority of them never do, but in those discussions you often uncover other planning needs. The final thing, I guess, to say about the firm, what makes us unusual compared to the majority of financial advice firms, is that we actually have in-house chartered tax advisors, we have in-house legal people, and we have our own trust company. So with that, we can generally cover the full gamut of planning that people need to talk about when it comes to estate planning.
Thanks, Neil. And yes, I'm actually amazed sometimes there are any people left on this island, the amount of inquiries we see of people leaving the United Kingdom. David, could I ask you to just introduce yourself, please? David is our head of wealth planning And then David, if you wouldn't mind just moving into giving us a bit of background on inheritance tax in the landscape, please.
Yeah, certainly. So, everybody, my name is David Morley. I'm head of wealth planning, as Ben says. Basically, that means that I've got two specialist teams that sit within my remit. One is a pension specialist team. So as we do cross-border, a lot of pensions can get very complicated very quickly. So we have a specialist team that can help and support the advisory community when looking at those type of cases. And on the other side is a specialist tax team, who are all lawyers and chartered tax advisors. And because it's cross-border, we've got a French national and a Spanish national looking after those particular countries, as well as the UK as well. So myself, I've been doing cross-border since the late 1980s and have been involved with financial services since mid 1980s. So yeah, I've been over 40 years doing this type of work. And just one other thing for you, Ben, talking about technology glitches, the slides have fallen away from my good self, but I do have a copy here, so I may ask for a little bit of guidance as we go.
Yeah, absolutely no trouble at all. We can always count on technology to cause us issues. So before we actually go into talking about the UK landscape, David,
Exactly.
in terms of what's happening, do you mind? There's a lot of people on this webinar that are actually based overseas, and they're asking the question of, well, actually, is this webinar really relevant if they live overseas? What's your view on that?
Yes, but mine is it's very relevant indeed, most especially where you have UK cited assets, because UK assets are real estate from April of next year, pension funds, bank accounts, are all UK cited for two purposes. Number one is succession law, so you have to be cognizant of that, which we'll touch on, I'm sure. And the second is for UK inheritance tax. Often in these situations, you then start to think of double tax treaties, because for income tax, capital gains tax, corporate taxes, there are many of those treaties, and they tend to push the liability to one jurisdiction or another. Right. For inheritance taxes, the UK only has 10. And in a European context, Ireland, the Netherlands, and France are the three that I remember. Italy, I think, is the other one. So that's 4 of them. The others are USA and India and places like that. So very rarely is a double tax treaty, which tends to mean that succession taxes can be a Gordian knot at death. So.
Excellent. If we come back to the UK, and I know one of your favourite quotes about estate planning comes from Mr. Roy Jenkins, whose screen I will put on now. Do you mind just talking us through what he really meant when he said his statement?
Yeah, so that would have been, kind of said really at the start of my career back in the 1980s. And at that point in time, planning for inheritance taxes was quite straightforward, in as much as that you could give things into trust, and you could actually benefit from that trust. And then things have gradually got tightened from 1986 onwards, whereby after the 2004 budgets, the inheritance taxes now are very real for a lot more people. The fact that thresholds have been frozen and will be frozen into the future as well means that growing asset values are drawing more people into the inheritance tax net. So for me, it's a tax that, when he says broadly voluntary, it's become less and less voluntary over time. Now I think it needs to be known about, people to be cognizant and do planning around it, and it can still be voluntary, but you need to understand the tools that are available to you in the legislative landscape.
And from your perspective, when does actually starting to... Sorry, David. So just from your perspective, when does actually starting to plan for inheritance tax planning, when does that become really a very sensible thing to start thinking about doing?
Yeah, I think it always makes sense. I think when for a lot of estates, when you hear about it's, will affect the minimum number of estates, what people are thinking about is it's going husband to wife, you get an exemption, and then maybe the total assets or £1 million. But more and more, especially with pension funds now being drawn into the net, that £1 million will be breached. So I think when people start to get towards £1 million worth of assets generally, especially when they get through the £1 million barrier, at that point in time, inheritance tax becomes so for people to understand where they are and what actions they can take makes sense. So for me, it's when they break £1 million, and of course the more you have above that, the more planning that you need to do.
I'll make the point, Ben, as well. It's because a will is a public document. Many years ago, I went in and downloaded a copy of Roy Jenkins' will, being famously the Labour Chancellor, and even he, within his will, had done some tax planning then. So rather than being happy to pay some tax, he'd taken some steps to avoid paying inheritance tax legally.
I will make sure we don't delve too deep into politics and move on to the next slide, but that is a very nice additional point on there, Neil. In terms, David, of the tools that are available to individuals, we've obviously talked about exemptions, relief, nil rate bans. Could you just give us a bit more background on that, please?
So I think the way to think about it is there's a kind of a knowledge framework, understand what's out there, and then how that's applied, and Neil will be delving more into the practical sides of it as well. So this first part is a knowledge piece, which is in the law. The law has always had exemptions, reliefs, the rate bans. So the question for us is each of those boxes. So exemptions, what's an exemption? Exemption is something that sits outside the inheritance totally. Okay, so the familiar ones there would be transfers between spouses, very effective, or civil partners, very effective planning. The small gifts exemption, annual 3,000 exemption, for example, as well. The exemption from gifts from normal income as well is very popular there. Then you have other exemptions to charities and gifts to political parties. So those are the main exemptions that would fall within there and could form a part of planning. Reliefs, when we look at reliefs, really this is where we're thinking of primarily agricultural property relief and business property relief. So clearly business property relief has been changed in the 2004 budget, albeit that was amended just before Christmas. So rather than 100% of qualifying business property, now you're only 2.5 million of that will be 100% exempt, relieved, and 50% then, above that you'll get 50% relief, i.e. the 40% liability falls to 20%. Okay, so relief is just that. It's inside your inheritance tax estate, but you'll get a relief from the actual tax potentially payable. Nil rate bans, then that's
David,
just
before you move on to nil rate bans, I was just going to just pause for a moment there because there's a few people reporting that there's a bit of feedback on your side. So I think we're just going to try and get you some technical help in London. And Neil, I just wondered if you wouldn't mind just picking up and just explaining a little bit more about the nil rate bans that are available to people in the UK, please.
Yeah, sure. So effectively, this is the tax-free allowance, the £325,000 per person. It's been frozen at that level since 2009. So that applies to every individual from the day they're born. Everybody has a nil rate band. We also got the addition of a property-related nil rate band, which unfortunately increased complexity beyond levels it needed to. Rather than simply increasing the original nil rate band, they added the second one in. But that one is 175,000 per individual. with some conditions attached about who can inherit and having to have owned the property. Add them together, you get 500,000, and then if you're a married couple, that gives you the magical 1 million figure. The problem is, and a common misunderstanding though within the UK, is that people think I've got £1 million worth of allowances to use. You might, but unfortunately, when an estate exceeds £2 million, they begin to claw back the residence nil rate band from you through a process known as tapering. And without going into the maths of it, what that means is for a certain part of your estate value above 2 million, you have an effective rate of inheritance tax of 60%. So if your estate's around that 2 million threshold, or it's over or slightly under, there is some planning that you can do that can bring you instant benefits there. No need to survive 7 years. You can save quite a lot of tax overnight with some simple planning.
I mean, from your perspective, what are some of the biggest mistakes that families tend to make, even if they already have advisors and they've already got some basic understanding of these types of tools that are available to you?
God, we could talk all day just on this one question alone, but I think the common one is actually understanding the options and the implications and what's actually going to happen when a person dies. Because a lot of the focus in this type of planning is, my tax bill is X, I want to reduce that, without really then understanding how an estate is administered following death. And there are so many potential traps there to catch people out and cause issues. So that would be probably the biggest one. But another part is really actually around having a concrete plan. I mean, most people's plan is up there, it's in their heads. And the trouble is, once you're gone, right? So how do your children, your grandchildren, other people who are helping, how do they know what to do? So I'm going to show in a few minutes some idea of planning and how you can perhaps deal with those issues.
Well, let's talk on that now, because one of the key tools, the key questions that kept on coming through from people both in the UK and Europe was all to do with wills. And actually, it became quite clear that for a number of people, they didn't fully understand exactly what the benefit of doing that actually would be. And then having, for some who have not necessarily been through the probate system, actually how that can actually play out in real life. So do you mind just talking and walking us through that in practical terms, please?
No, not at all. In fact, it's probably better if you bring up the next slide then to allow me to discuss that. Because as I say, what I find is when I meet people and they tell me they're concerned about inheritance tax, my first question is usually, okay, what are you worried about? And it's usually around the amount of tax that somebody's going to pay. And I say, okay, well, how are you, what plans have you got in place at the moment? And the reason a will becomes so important is 30 years ago in my training, I was told start at death and work backwards when it comes to this type of planning. And the reason, therefore, a will is so important is anybody could go today and say, okay, what assets do I own and how are they going to be impacted? How does my executor deal with this position? And what we're showing on screen there is, because people don't really often understand the process that they have to go through, is we've got an example there of a person dying in March, and the will then appoint the executors for their estate. And what basically happens is from the month following death, a clock starts ticking, and the executors basically have 6 months in which to go through the probate process, which is separate from dealing with HMRC. They have 6 months to get all the records together, and effectively then they have to pay the NEIHT liability. If they don't pay it within those 6 months, then interest starts getting added to the amount that's due. So you've got a bit of a catch-22 situation there often, that if people haven't really thought this through and think about the assets they own and how they're affected and the process that needs to be followed by the executors, it's really a question of how's the IHT going to be paid. And that's why a will to us is so important, because it gives us this base that we can say, okay, we know what you want to happen on death. Let's look at your assets and effectively see whether or not you have a problem. And often that turns out, once people begin to understand that, that becomes a lot of bigger consideration for them than the actual tax they're going to pay, because it's very common, again, probably 9 times out of 10, that the executors are either their surviving partner, if they are a couple, and the children, or the children alone. And if they haven't prepared for this part of the process, it's highly unlikely that they will do everything required within 6 months. And because the invitation to this webinar talked about pensions, if you've done any reading, if people have done any research on that, they'll see there's a lot of talk and a lot of fear about the extra and added complexity that pensions are going to add, to the point where the House of Lords have said they believe it will be nigh on impossible for anyone with a pension scheme to have to get this done and pay the inheritance tax due. So wills are really important, therefore, in that regard, in that is the start of the planning process, because we can work at death and start backwards. And I would ask people, therefore, to remember this slide in the 6 months and how it's going to be paid, because I'm going to touch again on how that impacts planning when I get to some slides later on.
And David, are you back with us? Can you hear us loud and clear?
I can hear you loud and clear, and I can see everything now. We've changed machinery here, so thank you for those people. Yeah, no, that's very good. Picking up on the wills piece as well, I think the legislation will permit a personal representative to delay or to stop 50% of the pension fund being distributed for a period of a maximum of 15 months from the month at the end of date of death. So in this example, from the end of April. And that's to give the personal representatives time to gather the estates, and communicate with the pension trustees. Where the money is going to an exempt beneficiary on a pension, so a spouse, for example, or a civil partner, then that that can actually be processed in the usual way from the recent technical notes. So there is that complication, but everything, not just a will related to pensions, like the beneficiary nomination, will all become really very important as well. So yeah.
And David, on that, moving slightly, because we will go on from wills after this question, is we have a lot of people on this webinar who are based either in Europe or the UK, but tend to have assets split across the 2 different jurisdictions, or have children in different jurisdictions. What's the sort of advice and guidance to people who have that situation to do in terms of their planning on that side from will perspective?
Yeah, so in a will perspective, what you're doing, where you have multi jurisdictions in play, you need to understand that the laws and succession laws in play are also multi-jurisdictional, and that often can change by asset type. So our generic advice has always been to understand the dynamic of the assets, with a view that whereas a multi-jurisdiction is to have a will in each jurisdiction, as that will conform to the protocols and law of that jurisdiction, and will allow a state administration to move in tandem, rather than a more linear process of getting an overseas will into the UK, for example, and then just signed off as acceptable, and moving on from there. So yeah, it can be very complicated. I know that from my own personal experience recently, where my parents are Irish, and on their passing, you had multi jurisdictional assets and actually having the two wills in place just allowed us to move on. And in one jurisdiction, it was really quite straightforward, and the other one more complicated. So we could handle that as a family without too much of a fuss. But that's because we'd thought about it in advance and did a two-will strategy.
And going back to the sort of main tools that people have available, we've obviously talked through wills. The second one up on screen at the moment now is trusts as well. I mean, the first thing that tends to come into people's mind when they hear the word trust is either complexity or cost. But David, what's your view on how you can utilise trusts as part of the planning?
Trust is still a very important part of UK planning. If you're overseas looking into the UK and thinking of trusts, you have to think of it from that perspective, because trusts don't work in all jurisdictions. But for UK and UK inheritance tax planning, they still work very well. You have to be cognizant of the 2006 changes. So for some trusts, you're looking at potentially lifetime transfers, but if correctly structured, then that can be avoided as well. So they do work very well. Can they be complicated? It's complex in law, but the actual mechanism of what an individual would want to see. So I'd like this trust, can I take an income from it, for example, or I want this trust, I want it to be a straightforward gift to children. Those elements can be very simple to understand and be very tax effective. On the trustee front, for most products, lay trustees work very, very well. Because you're dealing with the trust and a single investment typically. But I know Neil's got some practical examples of trusts and trusts in action.
Neil, do you want to go through those now?
Yeah, I will. If you can bring up the next slide, Ben. It's interesting hearing David talking there in this mention of complexity, because that is often the thing that's the criticism that's attached to trusts most often, is they're too complex. And I scratch my head at that one, because I don't think they are. You can definitely make them complex if you want, but what we're showing on screen there is basically every trust that you are likely to deal with will look something like this and have these parties involved. So in most cases, technically a trust doesn't have to have a deed, but it's always better to, and all the ones we work with will have a deed. So that's the thing at the top. All that is a set of rules, and it's saying what the trust is doing and laying out the parties, the people involved. So as people are looking at the screen there on the left-hand side, the term, we don't like using jargon, but we have to hear. So the person or people who set up a trust are called settlers. That's one party. In the middle there, you have the trustees. They are the people who have day-to-day control over what happens in the trust. And then on the right-hand side, you have the beneficiaries. They're either fixed or discretionary, i.e. the trustees can choose from a grouping you've given them who are going to benefit. And just for the sake of accuracy here, the reason a trust works from a planning perspective and inheritance tax perspective is because when the settlor gives money to the trust, which is that gold arrow at the bottom, settled sum, they're passing legal ownership over to the trustees. So as I say, this is pretty much how all trusts work. And a big part of what we're trying to deliver today is giving people not just knowledge, but confidence to make decisions. And there's often a fear of about losing control. But as David again has really said, in most occasions, there's no issue with the settlor being the trustee. So they can operate the same investment strategy. Talking through the process, you select the right trust, so they can usually create a scenario where they have access to capital and or income. And depending on how they feel about when beneficiaries get the money, they can choose a type of trust that either gives the trustees the control or puts it into a stated plan where the beneficiaries get the money at fixed stages. So there really is they all look like that. There really is, to me, no complexity unless you want to make it complex. It's just about going through a process and understanding what you're trying to achieve and finding, is there a trust framework out there that will suit your needs? If you go to the next slide, Ben, I've just done one more about, again, why people might want to consider a trust. And I do use this in my example in a few minutes. So some of the questions are often around the fears people have is, well, I'm not sure, back to this idea of confidence, if I'm going to need the money or not. So there are trust options that can allow the person who's the settler, the person creating the trust, to have all or some of the money back. But again, when it comes to this idea about 7 years, because when you set up a trust, you're making a gift to the trust, that original amount of capital, in most cases, still takes 7 years to fall outside of your estate. But there's an immediate benefit in the sense that any growth you make is outside the estate from day one. If you think back to my slide about probate and wills, once money goes into a trust, it's no longer subject to the probate rules. And again, when I talked about this £2 million threshold for the residence nil rate band, if somebody puts money into trust today and dies tomorrow, but that has the effect of bringing their estate below the 2 million threshold, they will gain an instant inheritance tax benefit with that type of planning. So trusts can really tick so many boxes for most people when it's just about understanding and getting the confidence to know where it fits into their planning picture.
Thank you, Neil. And David, anything you want to add on that?
No, Neil's explained it very, very well and very clearly.
So I know trusts were certainly a subject we had a lot of questions on prior to that. And if they haven't been covered there, by all means, again, as I mentioned earlier, get in touch with us. We'll be happy to talk it through in more detail. If we go back to the sort of key tools that you were mentioning earlier on, David, we've got the wills, trust, specialist investments, life policy and gifting. The third one on that list was specialist investments, if I can get my words out. And the reason is that people are obviously reading a lot of press about what's happening and what other options they've got available. So they were just asking, well, what else is available if I don't go down that trust route, and potentially how would I know whether that's suitable for me? What's your view on that? You're on mute for the time being, David. So that words of wisdom.
Thank you. Specialist investments, they can work very well. What we're thinking of here is using, if you remember from the gold squares earlier, using reliefs that exist within inheritance tax. So the two primary ones are the agricultural property relief and the business property relief. The type of investments you're thinking of here would fall inside the business property relief type of business relief category. And those will come into two broad camps. One's quite a conservative, steady Eddie, investing in lending and renewables, etc. The other can be in AIM shares, which clearly is far more volatile. But the key on both of them is ensuring that the construction of the portfolio qualifies for business property relief. And if that's the case, then you can invest £2.5 million per head to the investment and get the relief from 100% relief from inheritance tax at death. Clearly, you'd want these assets to grow going forward, that would have to be thought of with the new rules above the £2.5 million investment of investing. Looking at the other two, the life policy fits in with the pre-funding. If you think of it and think of Neil's slide about the probate and needing to pay inheritance tax before a probate will be granted within the time periods, then it's all about having cash at that point in time. And a life insurance policy is a very good way of spending a relatively small amount of money to create that cash at death that needs to be structured properly. But that's what we're thinking of there in terms of pre-funding and inheritance tax. And then the last one, which touches on Neil's trust parts, which are slides looking at gifting, is the 7-year rule. So you can gift to individuals, you can gift to certain types of trust, and all those will fit within that potentially exempt transfer 7-year rule, which means there's no IHT to pay today, survive 7 years from the date of gift, and it falls fully outside of the estate. So that's again a strategy that can be employed within the tools available.
And Neil, anything you want to add on talking about life policies or gifting in your experience?
Again, as I said before, we'd spend the rest of the webinar just talking about those two things. So I'm going to say no, just to make sure we've got time to cover what we need to. But I'm going to incorporate something on gifting a little later.
Fantastic. And before we go on to the segment really to focus on pensions, there is one other aspect that obviously Blevins Franks we see a lot of is the consideration of actually, well, if I'm a UK resident now, would moving overseas be beneficial for me to do from an inheritance tax perspective? But we also then have the reverse. We have people who are currently living overseas who are saying, well, from an inheritance tax perspective, would it make sense to move back to the UK now? David, what are your comments on those thoughts?
In terms of overseas works and can work very, very well. What people need to understand, or the piece of legislation that people need to understand, is how they're classified. Are they a long-term resident or a non-long-term resident? So a long-term resident uses the 10 of the 20 tax year test, which is basically, have you been resident in the United Kingdom for 10 of the past 20 UK tax years? So for most people leaving the UK, the answer will be yes. What does that mean? That means that tail will continue, and that's the UK inheritance tax tail, will continue with them for a period of 10 UK tax years. So at that point in time, their worldwide assets will continue to be subject to UK inheritance taxes. And that could be as well as local death taxes. There's usually a relief, a unilateral relief, one of the tax authorities would grant, but inheritance tax will be payable in the UK. So that's something to be cognizant of. Once you become a non-long-term resident, so beyond that 10 UK tax year period, at that point in time, it's just UK cited assets that become subject to UK inheritance tax. So again, it goes back to your bank accounts, your real estate, and from 6th of April of next year, UK registered pensions as well. Okay. For individuals living in a country with a double tax treaty with the UK for succession taxes, so France, for example, the situation there is that will speed up, if you like, the becoming non-long-term residents, as it will give the taxing rights to France. The but will be a double tax treaty just in law will automatically ensure you don't pay inheritance tax more than you should. So you pay in one jurisdiction or the other. So the primary taxing jurisdiction would be France. However, for UK inheritance tax, the assets in the UK will still go through the inheritance tax process. They'll still pay UK inheritance tax. It's just they will not be double taxed in France. So France will give an automatic credit for UK inheritance taxes paid. So yes, overseas can work very, very well. But because you jump on a plane today and arrive somewhere else tomorrow, doesn't necessarily mean you are outside the UK inheritance taxes net.
Yeah, and I think if that's some of the questions you've got, definitely do get in touch. We need to talk that through, but just out of the interest of the fact that we don't want anyone's inheritance tax planning to actually come into effect today while we're doing this call, we will move on. So we want to talk more about pensions, because obviously that is the big thing that's on a lot of people's mind. We've talked about overseas, so we jump that and we look at the fact that there's a new potential beneficiary. David, the questions coming up on this were, stemming from it. Is a pension even worth having now? What are my options? There's obviously quite a lot of fear surrounding this. What's your view?
Okay, in terms of a pension, yes, I believe they are worth having. Because okay, they've going from an inheritance tax exempt environment to be included inside the inheritance taxes net. But if you have it outside the pension environment, it's inside the inheritance taxes net as well. There might be a few more planning opportunities, but fundamentally, inheritance tax across the whole estate. Pensions, you will get tax relief going in. You'll get tax-free growth, and you get your pension commencement lump sum, so your tax-free lump sum as well. So all those things are not to be ignored because of inheritance tax, because at one level, an individual, myself or whomever, will not pay inheritance tax. It's only paid after we die. So and it's payable by the estate, so it's future beneficiaries. So at one level, pensions remain very, very good investments. What you then need to do is be cognizant of how you're going to use that when it gets into your retirement, because perhaps running it down sooner may be more tax efficient than running down other assets sooner. And that's the big conversation that is to be had during the planning process.
And when we look at the choices that I bring up on screen for people, obviously you've listed out really there are 6 viable options for people. Just walk and talk us through those, if you may.
Yeah, I think firstly it's worth thinking about kind of the entry points into this. So there are different types of pension. Will your state pension, UK state pension, be included in the inheritance taxes net? No. Why? Because it dies with you at death, so there's nothing to pass on. Equally, a defined benefit or final salary pension, they themselves usually will die with death, so there's nothing being passed on, so they don't form part of your estate. Where there are benefits that do continue after death, then the question is who's receiving those benefits, because there will be a value attaching to those benefits, which will be included in your estate. If it is a spouse civil partner, they'll be covered by an exemption, so there's nothing to be worried about there. However, if it's a common law spouse, as would be affectionately known in a legal sense, then yes, that will be a value will be attached, and that will be inside your estate. And then that leaves us with defined contribution pension schemes, i.e. those pension schemes where you can see and feel and touch the investment fund that will feed your pension retirement needs. And that's what's being thought about here on this slide. So taking the left-hand end and do nothing, that's the one where you're looking at the pension scheme, you have other assets, other income sources, and you say, actually, I don't need to draw from that. Well, clearly, on passing, that fund as a UK registered pension fund or an overseas pension fund, if you're a long-term resident in the UK, will form part of your estate for inheritance tax. Go to the other extreme, the annuity. So what's the annuity? That's taken and transferring the funds to the ownership of a life insurance company, who in return give you a fixed or a growing income payment, just like a defined benefit pension. That will depend on the terms of the annuity. So if the annuity dies with death, there's no value to be passed on, so it falls outside the estate. If there is a continuing annuity to be paid, then that will have a value, and that will be inside the estate. Again, if it's to a spouse, just like a defined benefit scheme, that would be exempted. Then in between, we have probably the options that are most looked at in a planning sense. So the income option is, I have a fund, I'm taking it to fund my retirement income requirements, and on that basis, then whatever's left at the end of the day will fall inside my estate for inheritance tax. Beneficiary nomination to a spouse, civil partner, or to a charity, as we've had with one particular client, that would be exempt. So it's inside the estate, but then it's exempt for inheritance tax. In any other situation, it now could have will have an inheritance taxable value. So choices that are starting to come through as thinking evolves in this space. Well, number one is, well, let's take more income and spend it. If your estate is low enough, you won't be paying inheritance tax. I've already said, you, the individual, don't pay inheritance tax. It's the estate post-death. So on that basis, what's wrong with taking all that, money and enjoying retirement years? So take more money and spend it as a strategy. The next one is to take more money, but because the additional income is in excess to your actual year-to-year needs, you could gift that income, and that could be gifted under the normal expenditure from income exemption. So that could be exempted outside your inheritance tax estate straight away. And then the last one is just a different twist on the previous. And that's to take more income, but you say, what I want to do is do a pre-funded strategy, i.e. to use that additional income to purchase a life insurance product that will create the cash at death to pay the inheritance tax. Okay. In all those situations where I say pay more income or take more income, you need to bear in mind, if you take more income, you'll pay more income tax. So that needs to be factored into the thinking as well. But that's kind of the continuum that's out there for defined contribution schemes. And that's where the planning conversation will happen as to what's right for you, given the retirement that you'd like to have.
Yeah, and Neil will bring that to life in a moment. And just for those of you thinking about timing on this call, by the way, we will be probably stopping at around 12:15 UK time, 1:15 European time. But until then, we will keep going so that we can get as many of the questions you've answered done. In terms of pensions, just to finish on that particular segment, wanted to bring it to life with actually some of the figures in mind. So David, you put this together. What did you want to walk through on here in terms of key points?
Yeah, so again, we're going back to defined contribution schemes. And what we're looking at here is firstly, that the tax position before and after death age 75. So today, if someone dies before age 75, they'll pay no inheritance tax, no income tax, and therefore the next generation, regardless of the relationship to the deceased, will pay zero tax. If the death is over 75, which is, we all want to live longer, good, healthy lives, then from April 2027, the only figure that changes will be the fund becomes inheritance taxable where the beneficiary is outside the exempt categories. So primarily charities and spouses and civil partners. So that would be at 40%. So therefore, suddenly that £100,000 pension fund will become, £60,000 in terms of what the next generation get to physically benefit from. Now, death after 75 today has always been income taxable. So it's that second line there. So depending on the tax rate of the beneficiary, they'll pay 20, 40 or 45%. Of course, now what we have to do is say, well, that would also be subject to inheritance tax at 40%. So what does that mean? Will they pay tax twice? So the £100,000 pays tax of 40% for inheritance. If it's not an exempt beneficiary, the answer is yes. So it's now 60,000 available. When they draw upon that money, the beneficiary will be paying income tax at 20, 40, 45. So there is that feeling of double taxes, which therefore means that if you have a 100,000 starting fund, it could drop in terms of physical pounds in the pocket for the beneficiary if death is after 75 and after the 6th of April of next year, to overall effective tax rate of 52%, 64 or 67, depending on the income tax rate of the individual. So £100,000 suddenly becomes, 480,000 or 360,000 or 330,000 to benefit the next generation. And it's in that space where the interest has grown and where a lot of the kind of commentary has been about whether this is fair or not. The There was some talk a couple of months ago of having some kind of credit for inheritance tax paid to offset against the income tax. The recently issued, which is 11th of May, so very recently issued revenue technical note on this has confirmed there will be no credit as the legislation is currently drafted. So the position on that slide of a double tax hit on that money is true.
I think you've answered a vast majority of questions that came up with just that one point, David. So thank you for that. Niall, I'm going to come to you in a moment just to sort of highlight some of the expectations versus realities of what you're seeing when you're speaking to people. But just one thing to mention, I see a number of you are obviously raising your hands throughout this. Just for time purposes, we can't stop at every moment and answer every question. But at the very end, there will be a QR code on the screen that you can scan, and that will give you further chance to raise more questions. And please do, obviously, as I say, if you're an existing client, speak to your private client managers as well. So, Niall, do you want to bring to life a little bit about what happens when expectation versus reality when it comes to inheritance tax planning?
Yeah, I think my first comment would be I'd eat both of those cakes. It wouldn't really matter to me. But what I find, I think, is that the trouble is there's lots of options, and it's not knowing the options that allows you to actually plan your estate. It's, again, we keep using this word confidence. It's about having the confidence to know how the right options impacts you financially, so that you can look at a model, a plan, and go, yeah, that works, I want to do it. If you go to the next slide, Ben. One of the things we talk to people about is we say, well, you know, what do you need this money to do for you? And it's quite interesting. Most people, when it comes to inheritance tax, kind of don't really tell us too much in the sense of, oh, I'd like to make gifts, I might do this, I might do that. The one thing they generally will mention is the worry about long-term care. So can I afford to do something now? What if I need to actually pay for care? What we want to do with people is build a model for them, build an actual plan so they can see the impact of certain decisions. What happens if I do this? What happens if I do that? So if you go to the next slide, Ben, for example, that plan might take into account a lot more things. Now, those might be too small for people to actually read on whatever medium they're watching this on. But the idea is, if we put all these things into an actual plan, we can then model how they impact you financially. And if we do that, you can then say, great, things are looking better than I expected, therefore I'm going to do this. Or, okay, that doesn't work, I'm not going to have enough money, let's go back and let's keep tweaking. So we call that your wealth plan, and we think it's a really valuable component now in terms of actually understanding and really getting the confidence to plan. If you go to the next slide, I'll show people what that actually looks like in terms of an output. And it's very visual. Yeah, that's one of the benefits.
Before we moved on to that, there was quite a few questions that have come in around, well, if I don't have a plan, I don't want to make a plan, then what actually happens at that point? And I know you've previously talked about, well, doing nothing is still a plan and a decision in its own. It's just whether that's the right plan. What's your view on that?
Well, the problem with, you can, of course, it's your money, you choose to do nothing. But then if you also want to avoid inheritance tax or look at certain implications, then unless you plan them, unless you model them, you're going to make your decisions based on having incomplete information. So I would generally say I would try to work with somebody who doesn't want to go into spectacular detail, but obviously you've got to do, if you really want to look at this in detail, you have to do some modeling.
So we come back to your scenario planning. What are we seeing on screen here?
So very quickly to talk people through what this is, and it is a very simplistic example. Each of what we have here is a couple that are 67 and 64. Each of those coloured bars represents a different asset. So the light blue is ISAs, the sort of beigey colour is cash in the bank, and then we're saying they have two pensions here. So that's sort of pinky red colour is a pension, and the brown is a pension for both people. And the reason that the slide has the head current planning is, as David alluded to, what a lot of people have been doing up until now. If they've been drawing an income from their assets, they've basically said, well, the pensions are outside my estate, let's leave them untouched, and let's spend what we need from the other assets that are part of my estate. So the logic being you were shrinking one and increasing the other in doing some tax planning. In the model here as well, we said that people live up to their early 90s, and here the only other income they have is full state pensions each, and their expenditure is 80,000. So what we're saying is they're spending from their capital around about £55,000 a year. So the first thing people want to understand is, will my planning get me to the end with enough money, or making sure I don't run out of money? So what you're seeing is, because the bars are high there, the answer is yes, you make it through. By the way, another important thing is the values here are after inflation, so we are allowing for inflation. And you can see the bars going up and down at places. They're also using real market returns. So rather than using linear returns, we're trying to model realistic scenarios. So this is the way a lot of people are looking at things currently, and this is what they've been doing. One of David's things was, well, what can we do? And I've seen a lot of this in the press. People are now saying, okay, well, I'm going to start taking some income from my pension. My comment would be, well, that's absolutely fine. There's no issue with doing that, but have you actually modeled that and seen what the impact of doing that is? And this is what the next slide shows. So the coloured bars are exactly the same, ISAs, cash, and two pensions. And all I've changed here is where they take the income from. Now, in the last slide, it was all coming out of the liquid assets that were in the estate. Here we've flipped it over and said, well, let's take it out of our pensions, because the logic people use when they're thinking about estate planning is, if I draw up to my higher rate threshold, for example, I'll pay income tax at 20%, and therefore surely that's better than paying inheritance tax at 40%. And if you model that, you can actually start to see whether or not that's true. I should have mentioned, by the way, on the last slide, the value on the far right of the bars was, the final value of the estate was about 1.1 million, which was made up of two pensions. So you have that probate issue again because it's pensions. Here, the final value is 749,000. So in other words, considerably less than left over if you go the pension route. Why the difference? Well, it's because in the previous slide, the income in the early years meant no tax was being paid, whereas here you're losing quite a bit to income tax each year. So you're having to take more money out in order to get the same net income. And the knock-on long-term effect of that is you have less money in your pot compounding. So I'm going to summarize all the numbers in a minute, but visually you can see here that, again, by doing this, you've achieved the objective of depleting the pensions now, and instead you're left with quite a lot of money in ISAs and cash. So you might have achieved something from the probate perspective of speeding things up. The next slide, Ben, if we go to that one. So again, the only difference between this and the last slide, here we're still saying that people are taking the income up to their unused basic rate band from the pensions. But because this isn't a plan, isn't a static thing, it needs to be fine-tuned and tweaked as legislation changes, as a person's needs changes. All we've done here is say, well, let's assume that these people are mid to late 70s. They've got to that point, they're reviewing it, and they see their ISAs and their cash are of considerable value. So what we've done there, almost halfway through exactly, you'll notice a dark blue bar added to the top there. And what we've said is we've transferred 500,000 in today's money terms across into a family trust. Then continue as usual spending. And the difference now is the end value here is 752,000. So only marginally more than the previous slide and still a lot less than the pension slide, because of we still have the same problem. By taking income from the pension and paying tax, you have to take more, therefore your assets are compounding. There's less in your pots to compound. But again, from a probate perspective here at the end, because you've got very little left in cash and most of your money in a trust, it's actually a far better position to be in. But as David again pointed out, the problem with pensions is not only inheritance tax. If we assume the majority of people are going to die after 75, then we have to factor in the income tax part to that. So if we go to the next slide, which is just a summary of the values, and we actually look at this, slide one is the second column in after the headings. We've then got the middle one saying if I take income up to basic rate, using the basic rate band, so up to the higher rate threshold, and the last one. The top row is the final values of the estate. So if you just looked at that, you could basically say the best option is to do nothing if you have pension funds, just sit on the money. If you go down though to row number two, and then we factor in inheritance tax, so we've actually got some real numbers here, you can see that you end up paying, yes, a lot more inheritance tax, but that's simply because your estate's so much bigger. Bring it down again to net estate though, the third row down, and you look across the three options, you can see that just taking money out of the pensions to pay tax at 20% to avoid a 40% inheritance tax charge, mathematically, if we were to stop at this point, you can see that's not a good thing to do. You'd be far better off leaving the money in the pension scheme, paying a lot more in inheritance tax because there's still money left over. The trust route, the last column on the right, brings you out ahead again. So that's the best option of all. But again, I should have said, by the way, I'm assuming this couple, all of their IHT allowances are used with their house. So hence why I'm applying inheritance tax to the full amounts here. If we then come to this critical factor, though, of what happens if you die after 75, and we take the information from David's slide about the tax rates, you look at other taxes, i.e. somebody drawing and paying income tax at either 20% or up to 45, you can see that scenario brings the net estate down to between 380,000 and 553. Go across to the one where you've been drawing out the pensions and they were therefore depleted and all you had were the ISAs and some cash left over. Well, there's no further taxes to pay there. But you can see there, just from those two numbers alone, it's still not a clear-cut decision versus the do nothing or pay or effectively take some money out now and pay income tax on it. So this is not as clear-cut as people often think in terms of it's 20% versus 40% and income tax. It will very much depend on a huge number of factors. What is very clear, though, is if you look at the last column, if you put that 500,000 into trust, as I said, about halfway through those bars that we were looking at, and the trust grows at the same rate as the pensions or any other assets in this example, there'll be some taxes to pay on the growth in the trust, but your net position there is far better than the do nothing or just draw out income. So to summarize really what I'm saying there, this is why planning and actually trying to create a model, in my opinion, is so important, because it doesn't mean it's up there. It becomes visual and it becomes real numbers. And then you can then look at these numbers and say, okay, is a particular course of action clearer than another? And if the answer is yes, and that course of action works for the person, then that hopefully gives them, back to this word, confidence of which path they actually need to go along. I'll pause for breath there, because I don't know if David's got any comments he wants to add, or Ben, you've got anything that you would add into that.
Yeah, I think I'd add one thing. The nice thing about the modelling is when you're doing it, you can only plan based on today's legislation. Clearly, you can plan on tomorrow's legislation if you know it's going to definitely happen. So the April 27 pension changes, for example. One of the other lovely things about modelling is if it's done each and every year, you can kind of fine tune from model one to make sure it really works, and then that's one of the keys to maximising, I think, the tax efficiency of the overall structure. But also think of it as an overall structure, not just individual elements.
And David, that's almost a great segue to my final slide, which was the next one that Ben brought up here, is this heading reality. As I said, this is a really simplistic example here. It assumed that a person had a rising income for life, which is what a lot of the rules, so-called rules on taking income out of portfolios assume. But the reality is, of course, actually usually different. The vast majority of people, just because of their physical abilities, end up traveling less, and therefore they spend less, which in turn can therefore mean that if you're taking less out your portfolio, it's going to grow every year. So I think your point, David, is accurate, and it's very valid, which is you need to, a plan in any model is only as good as the input into it. And because we don't know what the future holds, we have to therefore constantly come back and look at it. Because if your reality is more like what you're seeing on screen now, i.e. you're spending tails off, then the likelihood is any actions you've already taken will need to be reviewed with a view to how does that impact things longer term. So again, I think a plan's really important. I think modelling is really important, so that you can try and give yourself the confidence to make sure that you don't end up in this scenario whereby if your inheritance tax bill goes down and then starts going back up again.
And with that in mind, Neil, what does actually a well-prepared family succession plan look like beyond just the financials?
But I think you answer a question, or I would answer a question with a question there is, and it really comes back to this: how prepared are people, be that your family, your executors, to take on this role and be involved and know what they're letting themselves in for? It's no good just having a plan in your head if the people who are going to be administering the plan, the executors, don't know what that is. So I think a lot of this is around understanding how your asset base is made up, how that will be treated after your passing. Can your executors use the money? And then involving them not after death, but making sure they've had a discussion about this before death, so that they are ready and prepared for what's coming. And again, just keep tweaking, I think. And so it's have a plan and keep reviewing it, Ben.
Excellent. And David, any final points you want to add on that?
No, nothing from me. I think Neil's covered all my thoughts very, very well.
Excellent. Well, look, we're heading towards the end of this morning. So I think just in summary, what we need to obviously highlight is that we've been through quite a number of the different tools that are available to you. But the reality of this is that it's not a one size fits all. The tools on in front of you now and the tools in front of you on this slide as well are things to be considered, things to be talked about. And the more we understand you and what you're actually trying to achieve, we can work with you to actually create what effectively becomes your plan. As we've talked about with it throughout today, the next steps are pretty clear. Is it too late to start? As we mentioned, the very best time would have been years ago, but the reality with all these different changes and the fact that it's constant, you need to be evolving your plan and looking at what changes are happening and what they are going to do to impact you, because you end up with a few different options of whether actually your biggest beneficiary becomes HMRC or some other tax jurisdictions across Europe, or potentially with a well thought through plan, your family. And it's about then what money can do for that, because as it comes back to in a number of the conversations we have with people, it's not just about the finances, it's about what that supports, whether it's a gift to a child to help them get on the ladder, sending the grandkids off to school, or helping a family member with some care home fees. That's the reality of the money. So in terms of questions, obviously our role is to help you navigate your financial peace of mind journey. I'm shortly going to put up on screen the scan that you can do, but we thank you again for the questions that you had in advance. We hope that today has answered a number of those questions, but there will likely be a number of questions that today has actually raised as well as you start to think more about your future. So we are here to help you plan that peace of mind journey. And we want to thank you again for being with us. On screen now, if you've got those further questions, please do scan and send us the questions, or give us a call, or send us an inquiry to the email address on screen. My final thank you is just to David and Neil. Thank you for all your expertise. Thank you for everybody at home bearing with us while there was a few little technological impacts. Hopefully it didn't spoil your experience. It's a cracking subject to discuss in more detail. Thank you to all those who are Blevins Franks clients as well. And we look forward to hearing from all of you in due course. All the very best. Thank you for your time. Bye-bye.